Alrighty, we're on now on module two. So hopefully module one, you learn through the basics of right those elements and those characteristics. You talk about underwriting, right? So a lot of terminology. So now in this module, we really need to focus on the types of policies that are involved, and we have a lot. So let's get started first with the traditional whole life policies for topic one. So let's just review some terms really quickly. Remember that premiums, right, are the amount paid periodically to the insurance company by the insured for coverage, right? Remember, death benefit is is the amount of money that the insurance company pays to designated beneficiaries upon the death of the insured people. Now, for these two, right, we've already talked about a lot. But the cash value, this is new. Okay, so let's pay attention to this term. When a premium payment is made, okay, did you know that a portion of it is used to cover the cost of insurance, right? Um, and administrative fees. Oftentimes, the remaining portion is allocated to policy's cash value account. So cash value grows over time, right, based on interest rates set by the insurance company, or it can be a variable rate. So basically, when we think about insurance, right, we want to be thinking about, okay, we have premiums, we have death benefits, and cash value. Now, why is cash value important? Well, although um, cash value, right, the individual doesn't receive the cash value, or the beneficiaries don't receive the cash value upon the death of the insured, the applicant, right, with the policy owner can often utilize cash value. They can borrow against the cash value, right, during emergencies, right? So cash value can be utilized during times of emergency, right? They might need to borrow some money, um, and that's called borrowing against the cash value, right? Because the cash value is growing, you might have some funds, and you might be able to borrow some of that, right, during emergencies, in that case. Okay, but it's more, we can think about it as like a living benefit, right? So instead of just having a death benefit, right? Cash value is more of like a living benefit. It gives you backup just in case where one needs to utilize money, right? Or borrow against that cash value. So when we take a look at traditional whole life, we first want to look at our ordinary whole life policy. So with our ordinary whole life policy, these provide death benefits for the entire life of the insured, right? So um, it also provides living benefits in the form of cash values, okay? And it matures at age 100, okay? Something else is that it also has a level premium. So let's kind of break this down, right? So first of all, right, what does it mean by that it matures at the age of 100? Well, that means, right, that coverage is in effect until 100 years old. Okay. And if the insured doesn't pass away by that time, right, the death benefit will be paid out automatically in many cases. Okay. We already mentioned the cash value portion, right? And then what does the word level premium mean, right? What does the word level premium mean? Well, this is in which, right, the premiums that one pay is consistent, right? Is consistent. So this is where that, okay, you always pay 200 every month, right? You don't, that doesn't change. Okay. Now, number two, we're talking about limited pay whole life. Okay. So this is where the insured is covered for and for his entire life. Okay. But premiums are paid for a limited time. So in this case, right, the premium payment, because the premium payment period shortens, right, the cash values increase faster and the fixed premiums are higher, right? So instead of, paying $200 a month, right, for the rest of your life, right, we might maybe be paying $800 a month, right? Maybe just for 20 years, right? So maybe like a shorter period of time, okay? So that hence it's called limited pay whole life. We also have single premium whole life, right? So this allows the insured to pay the entire premium in one lump sum and have coverage for the insured's entire life. So in this case, immediate cash value is formed, okay? Because, right, there's that sudden payment, right? There's that lump sum payment. And then for our fourth type, traditional kind of whole life, we have modified whole life, right? So where one pays lower premiums in the earlier years, right? So maybe we have an individual who just got a job, right? Just kind of hitting it off with the business world, then they might not be able to pay so much premiums in the beginning, but eventually, right? Later on, they might be able to, right? So there's that sudden jump, right? Um, Later in the years, right? And it remains fixed thereafter. Okay. So premiums increase just once, but it's a good opportunity, right, for individuals to pay lower premiums in the beginning, in earlier years, and eventually it grows or changes. So now let's kind of look at this graphically. Okay, let's look at this graphically because this often helps students understand what's going on. So we can see, right, with these traditional whole life policies, right, death benefit always stays the same. We can see that cash values increases over time, right? And we can see that the premium never changes too, right? So you're always paying that $200 in premiums, right? Your death benefit might always be $1 million in death benefits, right? So we see that in this case that the premiums are always stable and level and that the death benefits are guaranteed, right? And so that is the key characteristics of these traditional whole life insurance policies. Now, remember, right, we want to when we look at all these policies, we want to always kind of compare them, right, to how is the premium changing, how's the death benefit changing, how's the cash value changing, and we can kind of summarize by now that it stays more or less the same, right? That benefit's constant, right? The cash value increases at a fixed rate, right? Right, we can see what that increases constantly at a fixed rate, right? And the death benefit stays the same. So premium death benefit stays the same and cash value increases at a fixed rate. So now let's take a look at this multiple choice question. It's a really good contextual question. On the exam, right, it's common to see, oh, I give you a situation and tell me what is the most appropriate policy for this individual. So take a moment to read and answer to this, and then we'll take a look at it shortly. Okay, so now let's go ahead and take a look at this one here. So we know that R has just graduated from law school, right? So right now, right, R's earning isn't that high, but expected to increase in the future, right? It's expected to increase. So which of the policies would best suit R's needs? Well, that would be C, right? We just looked at with our modified whole life, right? That would provide individuals with a premium increase just once, right? So lower premiums in the earlier years and higher premiums in the latter years.